Over the next couple of years, nearly $1 trillion in commercial real estate loans are scheduled to mature in the United States. A significant portion of that hits in 2026, and many of these loans originated in a very different interest rate environment than the one we're operating in today. Some owners won't be able to refinance. Some will face major payment shocks. Some will be forced to sell even when the underlying real estate itself is fundamentally sound. In this video, we're going to break down what the 2026 CRE debt wall, commercial real estate debt wall, actually is, why it matters, and how it can create opportunities to acquire shopping centers at a discount if you understand what you're looking at. Let's start with the basics. According to the Mortgage Bankers Association, roughly 20% of outstanding commercial mortgages, approximately $950 billion, will mature in 2026 alone. When you zoom out, estimates suggest that $1.7 to $2 trillion in commercial real estate debt will mature between 2026 and 2028. That concentration of maturities is what people are referring to when they talk about the CRE debt wall. Here's the key point. Most of these loans were written during a period when interest rates were near zero. Many borrowers locked in borrowing costs in the 3 to 4% range. Today, refinancing that same debt often means rates closer to 6 or 7%, sometimes even higher depending upon asset quality and lender appetite. That difference alone dramatically changes the math. When a loan matures, an owner typically has three options. 1, refinance the loan. 2, sell the property. 3, bring in new equity to pay down the loan balance. In a stable capital market, refinancing is usually the default option. But today, lenders are underwriting more conservatively. Loan-to-value ratios are lower, debt service coverage requirements are higher, and banks are more cautious, particularly around commercial real estate exposure. A loan that once worked at 70% loan to value with a low interest rate may now only qualify for 55 or 60% leverage at a much higher cost of capital. If the net operating income hasn't grown enough to offset that increase, the debt service coverage simply doesn't pencil anymore. Monthly payments can jump 50, 75, even 100% in some cases. That's when refinancing stops being an option. Owners are then faced with an uncomfortable reality, bringing fresh capital to the table or sell the asset, often sooner than they planned and sometimes at a price they didn't expect. This is where distress starts to appear, not necessarily because the real estate is bad, but because the capital structure no longer fits the environment. This is also where opportunity is created. Debt distress doesn't always mean property distress. A loan can be over-leveraged or poorly timed while the real estate itself remains viable, well-located, cash-flowing. In those situations, forced selling can occur. Owners may decide that injecting new equity doesn't make sense relative to their expected returns. Lenders may prefer a sale over a prolonged workout, and buyers with capital and patience can step in. For shopping centers, this dynamic is especially important. Despite all the headlines over the last few years, necessity-based retail has held up remarkably well. New retail construction remains limited. Well-located, grocery-anchored, and service-oriented centers continue to see demand. And in many markets, available space is still tight. So we're seeing an interesting disconnect. On one side, capital markets are under stress with maturing loans, higher rates, cautious lenders. On the other side, the underlying fundamentals of many shopping centers remain solid. That disconnect can create temporary pricing dislocations. Assets may trade at discounts not because demand has disappeared, but because the previous debt structure is no longer sustainable. Those are the situations we pay close attention to. At Rockstep Capital, we spend a lot of time operating at this intersection, where the capital stack breaks, but the real estate story still makes sense. For investors watching the cycle unfold, there are a few important things to pay attention to. Look closely at loan maturity schedules. and where distress is likely to surface. Watch how sponsors respond. Proactive balance sheet management matters. Focus on trade area strength and tenant mix, not just headline cap rates. And most importantly, scrutinize underwriting assumptions. Ask what interest rates are being assumed on future refinances, what exit cap rates look like, how expenses like insurance, taxes, maintenance are modeled. If everything assumes a quick return to easy money, that's a warning sign. The 2026 CRE debt wall is very real. Hundreds of billions of dollars in loans are maturing in a higher rate, tighter credit environment. That will create pressure and in some cases forced selling. But for disciplined, well-capitalized investors, it also creates opportunity. At Rockstep Capital, we're not trying to predict when rates fall or markets loosen. We focus on owning durable shopping centers in strong locations, structuring conservative debt, buying assets at prices that make sense even if conditions remain uncertain. That approach doesn't eliminate risk, but it does control it. And in periods like this, controlling risk is often what separates long-term success from short-term speculation. Thanks for watching.